The Alpha Horizon. Thinking different, acting aware.
1 year ago, after the start of the COVID crisis, markets went into panic. Bonds from large government-backed corporations offered record returns to investors willing to bet on their survival. Today, we're in a state of euphoria. Not only have markets priced in a much lower likelihood of such end-of-the-world scenarios, but they've also moved to reflect a Goldilocks environment, a combination of strong growth and subdued inflation. The underlying consensus assumption, reiterated from the Fed chair down to most sell-side economists, is that inflation pressures will be temporary and that central banks will be able to keep policy loose, leaving the punch bowl out and the party going. What if they're wrong? Today, we're going to discuss this question. My name is Alberto Gallo, portfolio manager at Algebris Investments.
Why is inflation a risk against current market valuation?
US Treasury Secretary Yellen recently suggested that interest rates might have to rise a little bit to make sure our economy doesn't overheat. These mild suggestions left both stock and interest rate markets in a tailspin. And a few hours later, Dr. Yellen had to backtrack, saying that she didn't intend to make that statement. The sensitivity of markets today to monetary policy changes is an indication of how much 20 years of loose monetary policy, of QE infinity, now underpin record high valuations in stock markets and record tight valuations in credit spreads. Essentially, the market, like a patient under anesthetic, has now become addicted to the stimulus of central bankers. But we also know that this stimulus over the last 2 decades has made our economies very imbalanced. The combination of QE infinity or asset-based central bank policy with corporate tax cuts has benefited the rich, the asset owners, and large companies much more than the bottom up of the economy, individuals, SMEs, and as such, it has encouraged asset hoarding over investment and productivity. The result is that to encourage growth and to exit from secular stagnation, it is necessary to reform our economy and to spend to get the stimulus to the individuals and the SMEs that create new jobs. The Biden administration has undergone a very large stimulus plan, in part to support near-term incomes, in part to support infrastructure investment and green investment. But investment also requires materials and commodities, and producer price inflation has overshot 4% now in the US, in Europe, and China, and Japan as well. It is difficult to forecast the pass-through of higher commodity prices and PPI into consumer price inflation. However, it is possible that over the coming months, we will overshoot above central bank targets in a number of countries in the world. Now, will these overshoot be temporary or will it be permanent and stay here for the coming months? The question really lies in government decisions. Milton Friedman once said that there's nothing more permanent than a temporary government program. We believe governments will have a hard time quitting spending and that infrastructure and government stimulus will continue over the coming years.
How will central banks' choices change? Is this the end of QE infinity?
The short answer is no. QE infinity is still here to stay, but some central banks are gently tapping on the brakes as they are worried about rising commodity prices. For example, the Bank of Canada was the first central bank to recently taper its QE program. They announced a future tapering, a reduction of purchases. Other central banks like the Federal Reserve have adopted an average inflation targeting regime, which means that they will allow inflation to overshoot the target and also expectations to increase further until unemployment is at target as well and it's broad-based. So in other words, they want also the weakest countries and the weakest part of the population to reach full employment. The ECB is at the same time discussing this summer a change of its targeting regime during its strategic review. So we might see the ECB also moving towards an average inflation targeting. However, we can say that over the coming quarters, it might be a little bit harder for central banks to justify the current easy policy if commodity prices keep rising and if there is a pass-through to consumer prices. The end game, however, remains dovish, and this is because central banks around the world continue to shift towards a different reaction function. We have seen how board members of the Bank of England have become more dovish. We might even have a change in the Fed chair by year end, as the new administration could introduce a new candidate. This means that in the medium term and long term future, we might see a shift towards an even new type of monetary policy. Most central banks in the world, over 2/3, are already working on central bank digital currencies, which imply a lot of changes, for example, a change to distributed monetary policy, potential injections directly to individuals and firms, and potentially more negative interest rates should there be a crisis. So the real issue for investors here is that interest rates might be persistently below the level of inflation, eroding the real value of assets.
Where should we look for value today? How to rethink bond portfolios?
Any major jolt that hits the markets could undo the base for the substantial investor leverage that has made its way into them. It is assumed that leading central banks would race to support markets, and that is in most cases a valid assumption. But leverage depends on confidence. Should confidence start to unravel, the excess liquidity would rapidly depart. Central banks are watching this carefully, but might not be able to control it. This is a small paragraph from a recent Financial Times article by bond investor veteran Don Fuss. The article was titled "Bond Investing Needs a Complete Rethink." 2 decades of QE infinity have pushed investors to accept very tight valuations for government debt, or almost all below inflation, and very tight credit spreads. Today, the sleeping giant in financial markets is credit. We are seeing companies, both in investment grade and high yield, issue at record tight credit spread levels, with investors assuming that central banks will be there and that these companies will be able to refinance and continue their business as usual over the coming years, even though post-COVID leverage levels are much higher than pre-COVID. The reality is that both economies and the financial system are a lot more fragile, and we have seen that even a small withdrawal in central bank stimulus might mean higher interest rates, higher yields, and also higher credit spreads. As a result, we think it is time to be cautious. Our global credit opportunities strategy has plenty of liquidity and has been able to monetize the rising rates so far this year. Today, we are invested very selectively in credit, looking at issuers with robust balance sheets and that offer some upside in capital appreciation on top of their coupon. But the most important asset class to own, in our view, is convertible debt. The reason is that higher inflation and higher commodity prices will also mean higher values of real assets in the futures. So while debt remains a paper asset in the currency which is denominated in euro, dollars, or Japanese yen, it is important to have a claim, a call option on something that is real, whether it is the equity of a company or a real estate investment or a mine which is used to extract commodities. And our convertible debt is focused on value sectors, partly linked to the reopening of economies, partly linked to energy and commodities. And this makes over 20% of our allocation today. So maintaining a high level of liquidity, a very low duration because interest rates might go higher, a very limited amount of credit exposure, very selective, and a high amount of convertible debt for upside to inflation and the economic cycle is a recipe for the coming months. Thank you for joining our podcast. We'll be back soon with new ideas and new approaches to the world of bond investing.
The Alpha Horizon. Thinking different. Acting aware.